After recording the podcast with Kieran from Darwinex, I realized that I misunderstood a few things about how the platform actually works. Stuff I've been trading around for years without knowing. So right after we finished recording, I went into one of my Darwinex accounts and changed a few things. Based on what he told me, I'm going to show you that account, what I changed, and the return it's already producing for me. But first, let's go through the 7 things from this podcast that I think are super important, and honestly, some of them I completely missed until now. Number 1, correlation isn't what most people think it is. Darwinex doesn't compare your trades to others' trades. It compares your Darwin's return and drawdown over the last 6 months to everyone else's. Even totally different EAs can end up correlated over time simply because they produce similar return drawdown patterns. Number 2, correlation only hits your Darwinia allocation, nothing else. Permanent allocations, boosters, investor-backed capital, and index inclusion are completely unaffected by correlation. And if you get excluded from Darwinia for a month due to a correlation, your subscription fee for that month is refunded. I honestly didn't know that. Number 3, how the Darwinex index or fund actually works. The fund buys your Darwin like an asset and applies a hypothetical 7.5% stop loss. Get stopped out and you're not permanently gone. You can be bought back in after review. Capacity limits means there is a reserve list even for strong performers. Number 4, don't copy an EA, make it better, not just different. Changing a few input values isn't enough to avoid correlation long term, and that's what we've been trying to do with the team for a long time. Just combine multiple strategies, add filters, offset entries, adjust risk, but the goal is genuinely improved, unique version, not just a modified copy of an expert advisor. Number 5, grid martingale strategies fight that risk engine, but there is a workaround, and what Kieran shared here was very interesting. The risk engine tracks live exposure, the VAR, and grid martingale strategies increase exposure exactly when the engine wants to cut it. What Kieran experimented was to run the grid inside a portfolio alongside higher risk breakout strategies. So the engine's baseline risk is set by the breakout trades and the grid flies under the radar, which is something very smart, I can admit. Number 6, 4 things affect the risk engine, but position size dominates. Asset volatility, trade frequency, and trade duration all matter a little. Position sizing matters the most by far. So trade small, let the risk engine scale you up. Never swing your risk multiplier up and down. For example, don't change from 0.5 lots to 5 lots or from 0.01 to 0.1. You're making it worse. The risk engine punishes inconsistency, not size itself. And number 7, real diversification means checking if your trades happen at the same time, not just trading different assets. So just because you're trading different pairs doesn't mean you are diversified, and that's is so true. I can say a big news event like a surprise Fed announcement can trigger several of your strategies all at once, even across different assets. So the real test is look at your back tests and check if your strategies tend to open and close trades on the same day, same hour, or same week if they rarely overlap. That's a genuinely diversified portfolio. And now let me show you my Darwinex account. So if I go to the funded trading results and I type premium portfolio, you will see this Darwinex account, which has a small floating loss. It's $200 in a 100k account, so that's a small loss. It makes 1% a month, which, like I said in many of my videos, is just more than enough. That's the signal account. It has a very small floating loss, which obviously is important for the risk engine as well, because it shows less exposure. If I show you the track record, you'll see that this thing has been running for nearly 1 year now, a very stable portfolio going upwards. But pay attention to that. My monthly is 1%, and if I show you the Darwinex, you will see a fantastic performance because my rating is nearly 80 and the minimum to receive capital allocation is 75. So this stable growth, and you can see that with the Darwin is 1 point something, below 1%, but it's a good average. And the Darwin risk actually increased after I decided to trade this strategy. In other words, once I've put this portfolio together, and I'll share with you which are the EAs I'm trading there, the risk engine saw that I'm trading very low risk, so it multiplies by exactly 2.41 at the moment to execute in my Darwin. So I expect to have a good allocation from the beginning of next month, but the problem actually here I figured out is this correlation that I'm having with other user who figured out that these EAs I'm trading are a good combination, and these are the multi-pair, the Japan strike, the Euro stable, all of these stable grids that do not go with a huge floating loss, or at least the low risk currency pairs, and I've shown them multiple times, so I'm not gonna show you the MetaTrader again and again. But what I actually did is to add more expert advisors in this portfolio, different assets like the Happy Crude Oil Expert Advisor, which recently was launched by the Happy vendor. It will lower my correlation with the trader that is trading a similar portfolio. And like I said in one of my previous points, it's not that they are matching your trades with other traders. They're actually looking at your return and drawdown. So it might happen that they're trading totally different strategies, but if your return to drawdown is exactly the same, which is usually the case when people trade similar expert advisors, but it's not a guarantee. This is where you need to add to your portfolio. You need to diversify as much as possible, trading different assets. And my problem has always been that I fully transparently share my trading, my accounts with everybody, and people duplicate and we get correlated and nobody wins. Usually the first person who starts a Darwin shouldn't get correlated. Everyone else afterwards should be correlated. So don't try to replicate my portfolios or my accounts or anyone else's. You need to build something unique. They're looking for unique trading strategies, unique traders that are capable of bringing a good piece in their portfolio of traders, and that's what we will do from now on. We will build premium portfolios or a combination of different expert advisors that comply with all of the things I shared in this video, or especially the 4 things that matter the most. I will ask my editors to display them one more time in here. So if you build something unique, if you build a unique account, there's nothing to stop you with Darwinex Zero. You can build your track record, you can receive allocation, capital investors will follow you, and you can make some decent money. And if you want to learn more about how the Darwinex works, check it out right here. It's a great platform. It's nothing to do with the prop firms like we were suspicious at the beginning, because we have to be suspicious, right? It's the forex industry. So thank you guys for watching today's video. I love you, and I'll see you in the next video. Bye.